Afternoon, everyone, and welcome to today's edition of HomeGames. I am here with the delightful and very happy Rob Stevenson. We were just joking in the kind of before chat that like I'm really up and he's kind of just, British deadpan. But we'll see if we can kind of liven things up over the next kind of 45 minutes or so. So Rob, I think many of you will be familiar with, but he is director and founder of Kingmakers. I'm not sure if that's your official job title, but that's kind of who he is and what he does. He kind of set up Kingmakers and they're kind of, I guess, advisor consultancy business, but has built up a specialism, particularly over recent years in terms of all things M&A. So we're going to ask him about that. And I guess wherever the conversation takes us. So a lot of people are kind of familiar with this format now and have heard this preamble many times over the last kind of year or so. But for those who are new, this is how it kind of works. So we've got a chat down the side and people can chip in with whatever they want during that chat, whether it's on topic or off, but I'll probably only pay attention to the on topic stuff. And then there's also an ask a question button down at the bottom of your screen there, where you can kind of push your question up to me and I'll get kind of the notification and that will kind of cut through the noise a little bit. So that's it in terms of questions. I've got my own questions, but it's always nice to hear other people's. So if you've got questions for Rob, please send them our way. What else do I need to tell you? So the other thing is that our SOTAN flagship survey, State of the Advisor Nation, is still kind of live in the market and we're still looking for people to kind of fill that out. So there is a green button down the bottom of your screen there, which kind of does what it says on the tin. But if you've got a bit of time later today to kind of fill that out, we really appreciate any and all of the insight that you give us. So that would be really great if you could do that. The other thing to say is that hopefully you shouldn't have any technical audio visual issues. Hopefully you're seeing and hearing us loud and clear. If you do have any problems, there is a little button which says get audio video help. So click that generates a link and that should kind of reset things from your end. So I think that is all my housekeeping. So Rob, I'm going to kind of bring you in and let's do a little bit of pandemic reflection, because there hasn't been enough of that, has there? But kind of specifically on the advisor mergers and acquisitions front. So kind of from behind my screen over the last 18 months or so, it's felt pretty noisy in terms of the amount of press releases and announcements and headlines that you get through about deals at kind of every level of the market really, but particularly kind of on the advice and wealth manager and financial planning side. So I kind of wanted to see, as someone who's kind of helping advise on those deals, what your perspective has been on the past 18 months and whether it has actually in fact been noisier and maybe what's behind that.
Yeah. Well, certainly if you look at the headlines, for sure, there's plenty of column inches. I think if you think about the types of deals that are being done, the consolidators are generally as a group of people quite keen to publicize that because it's their business model, and so they're acquiring firms and doing that good work. I think there's a lot of private deals that happen which don't get publicized because there's no incentive to publicize them. I think that's the majority of the work that we do is private, so it's either internal deals or it's a private firm buying another private firm. Again, with internal deals, sometimes the business is being sold over a period of time. So when did the deal actually kind of happen, right? It's kind of
from the point of the talks to the completion, there's quite a lot that happens in the background there, isn't there?
Yeah, you could be many years. So for us, we normally work on about 12 matters in a year, 12 deals. This last year has been 17. So it's 42% for the mathematicians out there. And I know that number for a different reason. I didn't just do that off the top of my head. It would be impressive, but I'm not actually that good at maths, which is a worry for anyone that's going to get advice from me on M&A. Yeah, I'm not good at maths. Classic. So yeah, there is a lot in terms of supply and demand. There's a few things driving it. I think that on the supply side, there's an awful lot of people who have always had a 3 to 5 year exit plan, and of course, the pandemic had a number of quite widened effects, but we always like to think about this idea of the sort of hamster cage, hamster on his wheel, and the pandemic was just this big wedge that stopped the wheel. And so a lot of people have been very introspective and have been thinking about their lives and thinking about their loved ones and thinking about business, and a lot of people have kind of recalibrated that and come back and said, I'm not, when you're in the middle of it, it's very difficult to see out of that. As like we were talking about earlier, when you're inside a job, you don't necessarily recognize what it's doing to you, or you don't see the options, outside of that. And I think for a lot of people that went home for an extended period of time, it was all of us, people that had a look around their hamster cage and looked outside of it and went, oh, there's maybe some other things I could do with my life.
Maybe I need to jump off the wheel and prioritize other things.
Maybe I should spend some more time with my partner and go walking, and because that's a cool thing to do. That's most of what I did, but and I think there's probably a correlation between dog ownership and in lockdown, and
is that
and
what we
people
need to sort of start tracking if we're like looking at the advisor market? Is the amount of dogs being bought?
It's puppy tracker. That's what it is.
Right. Okay.
Yeah. There's a correlation and causation, I'm going to say, in that. But yeah, so we have had a lot of people that have come to us and said, look, we think maybe now might be a good time for that. And then on the demand side, you have still got substantial private equity funds that are looking for investments. And if you look at financial planning businesses, aside from some early stage volatility, a lot of these firms, the intrinsic value in them is sustained. We all make light of the fact that, you just switch client meetings to Zoom and away you go. It's not been anywhere near as simple as that for many people. It's a bit like, I'm old enough to remember the credit crunch was, I guess, another big shock to the system, and there was no new business being done because everybody was reassuring existing clients about their investments and what was going on, and trying to think about the possible scenarios that might play out. So I think that the intrinsic value of financial planning firms has stayed there, and because the demand side, the supply and demand has meant that the prices have been creeping up, and again you've got consolidators that started maybe 12, 14 years ago now, 10 years ago, some of them. And the private equity funds, tend to be like a 10-year closed fund. So, some early investors have divested, and because of the way capital works, you'll tend to, once you're in a private equity cycle, you're probably going to sell to another private equity firm who have a cheaper cost of capital, or you're going to try and list. So some of the bigger consolidators now are owned by mid-market, mid-size private equity firms, which I think, aside from the complexities of that, that's also then quite interesting because they have more capital to spend. So, yeah.
So I guess the next iteration of that then is the consolidated firms who might have amassed a few kind of recent advice acquisitions over recent years are now themselves going to kind of become the target of bigger, maybe not better, but bigger kind of consolidators or bigger private equity firms, and then that kind of cycle continues.
Yeah, we hadn't seen that much of it. We saw Bell Penny kind of reverse almost into Ascot Lloyd.
I don't know if that's complimentary of the deal or not.
No, I think that's a technical. I think that's what they did. Reverse one.
I see.
A bigger firm goes into a smaller one.
I thought you were painting pictures of like car crashes or something. That's
no. I didn't mean that at all. No.
Sorry.
No, it's a bit like years ago. Tarry Law did a reverse acquisition.
Okay, yeah.
That wasn't great, but yeah, they were kind of different.
Strike that from the record then.
Yeah. But I think we haven't seen much of it. But I think if you look now at some of the earlier consolidators, and you look at their growth, organic growth. I mean, you can't, live by the sword, die by the sword. You can't just sustain yourself with inorganic growth, because it's expensive in terms of capital deployed. So, if you look now at some of the earlier consolidators, they're very much, if you were an investor, you'd go on their website and think, oh, that's a nationwide chartered financial planning business. It's not, just a business that buys other companies. So they're in the process of morphing themselves, and that means different capital requirements for different types of projects and whatnot. So yeah, and they're all hungry.
Yeah. Yeah. Okay. Well, we might come back to some of those points, but that was good scene setting. Thank you for that. So if I'm an advisor or planner with that 3 to 5 year time horizon that you mentioned, what are the kind of things they need to be thinking about if they're looking at exit? And I guess, how do they even know that selling up versus, say, an internal route is even right for them?
Yeah, I think that it all starts with personal financial planning. And I'm not just saying that because that's my background originally, but it does start with that. So, the first question to ask is like, look, what is my proximity to financial independence? And it's not a question that financial planning business owners, in my experience, ask very often. Because
Well, to clients, but not to themselves, I guess.
Correct. Yeah. So it's a, take a deep breath, look in the mirror and ask yourself that question. There are some technical difficulties with it because, of course, if you put all of your finances onto the cash flow modeling system in the office, then everyone's exposed to it, right? So, but that's a starting point for us. Most people come to us with a sort of stick or twist question.
Okay.
Like when do I go? I'm not getting any younger. Love what I do. Yeah, helping other people sort of validates who I am as a professional and a human being, and I feel like I've got a place in the world. It's a bit deep, but that's kind of the narrative. Do I sell now? What's the value of the firm? What happens if I wait, for a period?
Okay.
So
Yeah.
we're always trying to start with personal financial planning and saying, okay, well, where are you at? Where do you want to get to? What's the gap? And very closely aligned with that is, do you enjoy what you're doing now?
Yeah.
And what might you do if you sold the firm? It's very, very important that people have a transition in terms of what they're going to do with their lives when they sell, because a business can be kind of really all-consuming, or it certainly has a big impact, on your life. And when you just remove that, you need to be going from something to something. So that's the sort of starting point. And a lot of the firms that we deal with have got multiple shareholders, so the complexity multiplies a bit because you're talking to lots of people. And then you're thinking about, okay, well, if I kept going for 3 years or 5 years, am I just going to get sort of incremental growth and incremental value? Or am I going to do some projects? What might those projects cost? What's the likely rate of return? And it's then an investment decision in terms of, like, if I stay for another 3 years and do various things that need to be done, am I going to see the benefit of that? Both in terms of earnings, but also in terms of business value. And a lot of that drives the conversation that we have with owners. And I have to say, the majority, you've basically got four options on an exit. You're either selling externally or internally. Externally, you're either going to a big company. We would characterize that as a consolidator, because many of them they might not like the title these days, but they are established to consolidate. They're there to buy other firms. There are some firms out there now that use more sort of debt finance, but they're the same thing, right? They're set up to acquire firms and get some fast growth. But now you have private, smaller firms, sort of mid-sized financial planning businesses with a few million of revenues, 3 or 4 million of revenues, that sort of area, where they're keen to do an acquisition of a smaller firm. And the debt financing, I'm happy to say, is now available for that, which is something we work tirelessly on to make it possible, to try and encourage firms that provide that debt finance in. So you can sell externally, and there's those two options: so privately owned firm or a bigger firm, enterprise firm. And then if it's internal, you're effectively, it's a buyout or it's a trust.
Okay.
So from the trust point of view, that's a fairly unique proposition, but the two are basically the same. You're going to use another vehicle to acquire your business. So the majority of firms that come to us would rather do it internally if they could. And I think that, there may be some confirmation bias there, because we do that work. We're sort of, if you imagine a management consultant, a Venn diagram with a management consultant and a corporate finance, with a sort of partial eclipse in the middle of that. So we'll do internal, but most people would rather do that. Now, that may be because, and consolidators get a bad press, some of it justified, some of it not. Regulator looked at that in 2018, wanted to tweak a few things, in terms of the behavior of some of those firms thereafter. And, you can't judge from the sidelines, and unless you go into those firms and see what's really going on. There's a lot you wouldn't know. But most people, whether it's legacy or it's fear of a larger firm or whatever, would say, no, I'd rather do this internally if I could. And of course, the first question you've got to ask yourself is, who's going to take it over? and because I think largely the credit crunch, where the bigger banks, which were the sort of training grounds for financial planning business, smaller financial planning firms, so they would train people because they could afford to, and those people would then leave and join smaller firms, which has been the same for all of my career, 20, 30 years back. They all pulled, with the credit crunch, they pulled out of delivering financial advice for a period of time, and it's created this generation gap. So we're frequently talking to someone in their 60s who's the founder, and someone in their 30s who's the next generation of owner. And the next generation of owner has genuine concerns about how they're going to do this when they've not maybe got married or, bought their dream house or had kids and all the costs that go with kids. Wow. I love my kids to bit, right, guys? Fine. But these life events that financial planners would be very familiar with, and so for the internal, you've got to think about, is there a viable person there who wants to get involved in this? The business can often borrow the money, so I won't go into the technicalities of that, but there's a way that the business can borrow the money to do it. But there is always risk attaching to it for the new owner. And then you've got to transfer all the clients, so there needs to be some credibility there. It's very difficult to go out. If any of the people watching this have tried to go and hire a sort of mid-40s chartered or certified financial planner, like they don't exist, right? The barriers to entry are still low enough, and the networks are still active enough that if they were good, they can set their own firm up.
Right. Okay. Yeah.
So that still exists. So those people are hard to attract. There are some firms that use their own equity to attract quality talent. I think that's going to be, quite apart from an employee ownership trust, I think sharing ownership more broadly is really going to have to happen in order to encourage quality people and retain them.
Okay.
So and then you've got to try to replace leadership and management. And I would characterize management as sort of, what are we doing today, tomorrow, next quarter, projects and various other sort of, it's like glorified admin, right? And I say that as someone who's done it for most of my career. And leadership is like everyone's celebrating a wonderful year and you're shivering in the corner with a glass of champagne, wondering about the PI cover next year and what it's going to cost, and and that sort of constant sort of paranoid.
The eye always being on something else.
Yeah, it's like, this is fine now, but the iceberg, there's that as well. So you're
smile
trying
and toast and
it's great, isn't it? I've got my fingers crossed furiously. So that's, and ironically, if you do have people that are very, particularly salespeople, and sales gets a dirty word, like financial planning services need to be sold, right? So there's a massive place for salespeople. I think, selling people products they don't need is a bad thing, but selling financial planning is still important. So if you have a salesperson is often quite independent and needs to back themselves and needs to, almost be not so self-aware and confident enough to bash doors down and get things done from a sales point of view. And leadership is about the diametric opposite of that. So leadership is about being very self-aware and putting everyone before you and, helping everyone up the hill rather than dragging them up the hill. And, so that the thing that makes you really sharp as a salesperson becomes your Achilles heel when you're going into a leadership and management role. So there's a transition from independence to interdependence for the next generation of owner. And so there's that, and then there's like personal guarantees and loans and, clients and who's going to deal with all these people. There's a lot to think about. And I think what that means is that, just to finish that bit, it just condenses down. It means that you have to have a certain timeline, and if you don't have that timeline, it's almost, well, forget it. If that person's not inside the firm and they're not looking like they can tick some of those boxes, not going to happen.
Yeah. And I guess alongside all of that, you've got to think about, the state of your actual business in terms of the processes that sit underneath everything, the ability to mine your data, and so when somebody comes and asks you due diligence questions about your business, you can sort them without having to be in sheet 17, tab whatever, if you like some crazy Excel spreadsheet.
Everyone's always in sheet 17, tab whatever it is. It's unavoidable, and it's always an enormous shock to the system, the level of complexity. You think, oh well, I've got recurring revenue and I've got some non-recurring revenue and I've got some overheads and there are some costs and whatnot, and you run into an enormous spider's web of complexity with any kind of transaction, and largely that's like whether it's internal or external. So we have a data sheet that we ask for, when we're sort of doing valuations and such like, and that is pretty light. There are some key things that we're after, sort of breakdown of the client bank, so we understand what's behind the revenue streams and what's behind, and then the team and what's behind the overheads, profitability, and obviously the accounts and figuring that stuff out. That type of information can help you to get to an offer, can help you in an M&A transaction to get to a point where you've got almost like heads of terms or memorandum of understanding, something like that, whether it's internal or external. It's then when you shift immediately after that into the first part of due diligence, which is financial due diligence, that's where the rubber hits the road. That's where, our checklist for that is like 500 rows deep.
Wow. Okay.
And I still think there's some stuff missing from that. Right? So that sounds daft, but that's the level of detail that you're getting into, because there's significant amounts of money changing hands and there's a lot of risk involved in that.
And that was one of the things that I kind of wanted to chat to you about, was that idea of that mental prep and the mindset that you have to have going into anything like that, in terms of, I think I mentioned this to you before, but kind of my only kind of tiny window into that world was kind of when I was at Nucleus and when they were kind of listing on AIM and things, and I didn't see probably 10% of it, but when I did see it, and it's 40 to 60 people CC'd on an email, they don't know the business and all of that kind of thing, you suddenly realize how much legalese there is, and how much stuff, like you say, there is to wade through. And I think it's something that Ruth Sturkett, Paradigm Norton, has talked about as well, just kind of be prepared for kind of being kind of knee deep and higher in kind of contracts and paperwork and just stuff that you didn't know existed behind the curtain.
Yeah. And like Ruth was doing a deal with Barry, right?
Yeah.
I think that's pretty friendly fire. Frankly.
That's like like-minded people coming together,
exactly.
and everybody's got the same goals in mind and all of that.
And I have enormous respect for William and and Barry and the guys over there. I think a lot of people do, because they're a good firm. But you still have to go through the process. It's not. There's no. God, if I had £1 for everyone that gets on a Zoom
it's just
call
my
and
mate.
says,
can we just skip this bit of the
this
process?
will be the easiest deal you've ever done. This is just going to be like 10 minutes and a couple of grand with a lawyer, and we'll have this thing done by lunchtime, and we can all have a ham and cheese toasty and celebrate, And it's like 18 months later, you're sort of still at it.
Yeah,
so
that's
I think
say on Grand Designs, they're going to be in the house by Christmas, and they're still there like 3 years later or something.
Yeah, and shameless plug, but also, when they don't get a project manager.
Yeah. I see what you did there.
You just bowled me underarm, and I took a full swing at it. No, but I think that for a lot of people, if you knew everything about it before you started, you wouldn't start. It would put you off, because it is overwhelming. I think a lot of people that are selling firms, they have to get up to speed, and they have a real incentive to get up to speed, because they understand that it's probably the biggest financial transaction they'll do. And if there isn't anyone supporting them, then quite often they will listen to the buyer, who is probably the last person you want educating you, because obviously they're educating you in terms of everything's great because we're doing it, and blah blah blah.
And they've
blah.
got their own agenda and their own kind of things that they're going to highlight and maybe de-emphasize, if that's a word. Yeah,
we're not going to shine lights in corners where there's a load of dust, right? So and that's not to do anyone any disservice. It's just who is representing you, in this transaction, who's on your side. And sometimes that's not always obvious, so it's very important to figure out where incentives sit in these deals. But yeah, if you start to get into like on an internal transaction, you start to get into the complexities of debt finance, and as the buyer, you have to get up to speed with that. That can be quite, like, it's almost overwhelming, you know, in terms of the amount of complexity there. And you know, you've maybe got a spreadsheet that says this is what we did last year and this is what we're going to do this year, and you think that's you know, that should be good. And then suddenly you're into, you know, forecasts and complexities of balance sheets and debt coverage ratios, and it's like you can't abdicate responsibility for that, because on behalf of your family, you're going to sign on the dotted line. So
all of this stuff is attached to a number which determines your future, isn't it? So
yeah, and again, lawyers, I mean, we have a panel of lawyers that we work with pretty closely, and they all have worked on financial services, you know, transactions, which I think is important, because otherwise you engage a lawyer who hasn't done that and you're going to have to pay them to educate them. So it's just adding another layer of cost to the whole thing. Whereas if they understand at a certain level, it's useful. But, you know, the main acquisition agreement is typically sort of 30, 40 pages long, and it's in very small print. And you have to sit there and go over it and over and over and over it. And it's amazing how much complexity there is in it. The basic principle is buyer is advancing future profits to seller, which seller's going to get out some now and a little bit later. And it's most of it is then balancing risk. That's where most of the complexity is. But yeah, it's drinking from the fire hose. Someone said to me recently, I'm drinking from the fire hose right now. Yeah, it's a bit of that.
I bet. Cool. Well, I'll pause just to kind of flag that I've got some questions, but if you do have questions for Rob, feel free to ask them and I will kind of work my way through them. But in the meantime, while people kind of think of those, I kind of wanted to talk to you about the valuation piece and maybe how that has changed, because I think it was traditionally talked about as kind of, the multiples of recurring income and all of that. But kind of over the last couple of years, I started to hear about firms asking different kinds of questions, which would then kind of translate into the valuation around average age of the client bank, average age of senior management, where's the kind of future of the business, intergenerational planning. Some of those questions are kind of coming up more in due diligence anecdotally. So what's your sort of take on that in terms of the way that advice and financial planning firms are being valued and whether that's changed over time?
Yeah, I think that it's an obvious question because everyone wants to know what they're worth, right?
Right, of course. Well, that's why they're having these conversations.
The only reason I get booked for anything, right? It's like,
just give me a number.
Give me the number. Just tell me what the number is. Stop with the flanning around. I think you have to think about why people are doing what they're doing. So most acquirers are not acquiring a strategic, a business that gives them resources. They're not acquiring something because they want to be competitive in a geographical location. So most acquisition strategies in this space are about synergy value. So in plain English, if you had a firm, financial planning business, and I had a financial planning business, can I either increase revenues or decrease costs if I put your firm inside of mine?
Okay.
That is the game. There's nothing else. That's all that really exists in that regard. So therefore you think to yourself, okay, there are hard and soft synergies. So soft synergies are what Consolidator started with. Is soft synergies are revenue increases. So if you think about, you could acquire a firm that's charging their clients 0.5% and turn it up to 1% if you can justify 1%. I'll go no further with that, but you could do that. Okay. Mm-hmm. Equally, you could acquire an accounting business and then sell them financial planning services. That would be the same thing. That would be, and there's a few firms now that are doing a bit more like a sort of broad family office that are looking at that kind of thing. Yeah, that's probably a little bit more sort of, that's an easier soft synergy to swallow for a seller than just we're going to hike the price, right? Then you've got hard synergies, which is effectively like, how do we reduce cost? And one of the biggest costs in a financial planning business is headcount. So then they're looking at, okay, if we're a growing firm, I always feel sorry for the accounts department. We've got accounts and it's very automated and we've got a scalable solution there so we can lose these people. So it's redundancies effectively. Mm-hmm. So if you keep that in mind, what is the buyer trying to do here? Because the old adage, a business is worth what someone's prepared to pay for it. is true. So you have to try to think about, well, why would they be prepared to pay this money for my company?
Mm-hmm.
The actual technical process has never changed. It's just that the narrative is changing a little bit now.
Mm.
So the technical process is, if you imagine like a T-bar,
Mm-hmm.
on one side you've got relative value, and on the other side you've got intrinsic value. So relative value is basically like valuing a house. That house is worth $1 million because others in the street are worth $1 million, and it's a similar shape and size. So that's relative. So your business relative to other businesses that are similar. So that is multiple of recurring revenue, multiple of profit, percentage of assets under management, all valid ways of valuing a firm, and they're all relative values, right? And we do all of them and come up with a range, because otherwise someone will just argue we should have done it one way or another way or whatever. So it's better to do them all. So you'll look at that, and then you'll determine where in that range that value needs to be. And when you're multiplying those various things like recurring income and various other bits and bobs, most buyers now will be looking at, are there small clients, and I'm using their narrative, not mine, but like every pound that any client has is valid, right? But are there clients that generate £1,000 a year that we can't really make money from? So in which case are we going to just chop them off and not buy them, right? Which happens a fair bit. Are there clients that are in their 70s and 80s where their life expectancy is shorter, and therefore should we trim those things off? So the relative valuations are such, that's where things start to creep in terms of how do we do that. The EBITDA, like the operating profit valuation, is the one that tells you the most about the intentions of the buyer, because that's where they do what's called normalization or adjusting for overhead. So that's where they'll start saying, oh, well, we could get rid of that person, and we can get rid of the premises and consolidate that into that place and do all these other bits and bobs. So those are hard synergies. And what we're seeing these days is that in this market now, which is really a seller's market, the buyer is effectively giving more of those synergies to the seller in the value.
Okay.
Whereas historically, where you had more of a sort of more of a buyer's market, they wouldn't be doing that. They'd be saying, well, all those things, we're going to create all those things in when we buy your firm and put it into ours. So that's value for us, not value for you.
Yeah.
So you do relative value is one side. And then, of course, what you really want to know as a buyer is, well, what is this? If I buy this at this market price, what am I going to get from it? So the intrinsic valuation is basically doing a forecast, figuring out what's going to change and making those assumptions on either revenue or costs, boiling that down to cash flow, and then basically use an interest rate to reduce that back to a net present value. Okay. So you look at all those cash flows and you go, if we bring them backwards, we get a number. And in simple terms, the net present value needs to be bigger than the current value. If it's beneath it and there's no alpha, there's no layer in between, then why are you doing this in the first place? Yeah, there's no actual investment return. So you can look at things like internal rate of return, you can look at payback period. There's a bunch of different ways of doing it. What's happening now is firms they seem to be quite keen. Everyone seems to be quite keen to not increase the multiples massively. That seems to be quite an emotive thing. So they'll be more flexible on older clients and clients that aren't making a profit. They'll be more flexible on how they're adjusting the EBITDA valuation. They might be more flexible on where they cut the historic data. So okay. if you look at a 12-month period and you start talking on that basis, and you've talked for 6 months, then at the end they might say, oh, well, tell you what, we can take the most recent 12 months. And do the deal on that basis. So there's a bunch of ways that they can bake more value in. Sorry, I'm disappearing up my rear end in terms of technical valuation stuff.
No, it's all a good insight. Thank you for that. So,
but you're trying to look, just in summary, you're trying to look at the market says it's worth that. I actually think I can make that out of it, and there needs to be fresh air between the two.
Yeah, I understand.
That's what's going on behind the scenes. Yeah.
Great. And then I guess as a kind of follow on to that then, so Ben Peel asks, hi Ben, first of all, he asks, is there a risk that there is so much private equity money chasing a limited number of targets that they are paying well above historical averages? So you were talking there about kind of offers being quite aggressive, and some of that will be kind of PE driven, but does it mean they kind of overpay, I guess is what Ben is asking.
I'm going to be political and say it depends.
Okay. You want to
I think,
expand?
yeah, sure. I think that there's two. If you're buying businesses, there's two factors that are going to determine success. And this goes all the way. This is not my thought on it, although I agree. It's Hans Christian, may he rest in peace, Harvard chap who wrote more on M&A than anyone pretty much has. It's basically price and fit.
Mm-hmm.
Now, price is obvious, right? You figure out, as we just discussed, you figure out, what you want to pay for something. When you figure that out, there are some assumptions that you're going to make. And those assumptions are generally being made by a group of people that are not going to actually realize those assumptions. So fit is all about how well you can integrate a company. So fit is something that happens afterwards. So the deal team, they're effectively, they play in the balance sheet world. What do we pay for this? And, how does that change our capital value and whatnot, and what debt are we going to use, and so on and so forth. And once the deal's done, then you've got a whole bunch of people who are in the profit and loss world. How do we make money out of this thing? And often the two have not surprisingly talked to each other about kind of what these assumptions that were made in the valuation. So if a valuation is really, really punchy, it's a really full price and problems exist in that integration, what it's going to do is it's going to put more pressure on integration to drive more cost out, to increase revenues more, to make that a good deal. So I think that it depends on what's incentivizing these firms. From a private equity point of view, you're basically looking at shareholder value. That's the game, right? You're looking at shareholder value and how much debt you can deploy into an investment that you have. So if you think of a 10-year private equity fund, you're effectively going to you're going to raise money, then you're going to spend the first 2 or 3 years looking for targets. Then you're going to deploy that capital. Then all of the deals need to be done in like a 3 or 4 year period before you start figuring out how you're going to sell it. So there's pressure in integration within a fund to then be able to actually realize the value for the investors in that fund. So in that cycle, you've probably got 5 to 10 investments in a private equity fund. So it's a little bit like portfolio management in that regard. I think that prices at the minute are quite aggressive. I think that is really reflective of a sort of there's a bit of a space race on at the moment. I think there's a bit of a sort of like, this is it now, we're going to buy all these businesses up and away we go. And if you think about 10 years ago, we had 6,400 firms in this country. We've now 2019 FCA figures were 5,111. And I think that will be lower again still. So we maybe lost like 1,500 firms. And is that a good thing, for the end investor or not? Not sure. I think if you're overpaying for a firm, it puts a lot more pressure on integration to get that right.
Yeah, because I suppose you're having to drive more to get more. Yeah,
drive more to the bottom line. The other thing that you're gonna run into is if you cut costs too hard, you just ruin the company.
Well, I was going to ask about that because obviously shareholder value will be the concern, but shareholder value may or may not equate to a better business at the end of it, isn't it?
Correct.
So I guess that's where the fit part comes.
Yeah, definitely. And I'm going to, carrying on this stream of thought, and also answering Russell Facer's question at the same time.
Yeah, so Russ has kind of chimed in and asked about how many sales actually kind of pay out in the ballpark of what's offered. Because I guess, to lure someone in, you say a price, and then maybe over time it gets chipped away at. So, yeah. And thanks for the question, Russ.
Yes, thank you, Russell. The old fish and chip gag. It's not quite as bad as that. If you have a price and there are some assumptions in that price, you're going to get maybe half your money up front. Tops. Maybe a private buyer might be able to give you 60%. That's another way that firms are being aggressive now, is giving more up front.
More up front, okay.
There will be an element that's deferred. And that element that's deferred is almost always contingent upon maintenance of income streams. It's the easiest way. If you boil it all down, you can think about, integrating through our complicated KIP and vertical integration, that sort of. If you maintain the income streams, that's a very soft way to do this. Also, maintaining the income streams is possible from the regulator's point of view, because in most cases you're buying and selling companies. and change of control is a much more arduous process now, quite rightly, than it used to be. So you really need a business case there as to what you're planning on doing, which I think is a good thing. But it's maybe the regulator hasn't matched the change in process with the additional resource, because certainly last year we saw things really slowing down.
In terms of authorizations and permissions and things.
In terms of like change of control in particular, it can
Okay.
drag. All it meant was that we saw more firms doing exchange and then deferred completion, waiting for regulatory permission. So if you've got this contingent deferred consideration, in plain English, that's an earn-out, is what that's typically called. So if you've received a really full price, and the firm then struggle with that integration, and clients walk, then you can say goodbye to your deferred consideration.
Yeah, there's normally like certain things kind of baked into that deferred consideration, aren't there, in terms of business performance, or I presume asset flows into a centralized investment proposition, if that's the structure of the deal, that kind of thing.
Yeah, I think to answer Russell's question directly, the firms that we've worked with where they do a transaction and they're using either debt or their own money, you're far more likely to see a very significant chunk of that money being paid. When you're into businesses where they're playing with someone else's money, you're far more likely to see reductions. From my experience, there are a lot of people that have not seen the full consideration, and therefore, they're going back and restating the deal from an HMRC point of view, because it's normal for them to pay tax when they've completed the transaction, like in that first year. So I think there are a lot of adjustments. Now, there could be a lot of reasons for that, and it's probably beyond the scope of what we've got time for. But yeah, I think it's very, very sensible to ask very serious questions about integration, because it's going to determine potentially 50% of what they say they're offering you. And sometimes the best offer is not the highest price. The best offer is one where you really are assured of a good fit, which means that you're assured of getting 100% of the consideration.
Yeah.
And that's something worth considering.
Okay, that's a good point. Yeah. And I guess following on from that, we've had a question come in around, so going back to your point about overpaying, putting pressure on integration, do you think the ease of vertical integration has been overestimated by some buyers? Because that's kind of the sell, isn't it? That if you go into a vertically integrated proposition, that will help everything. But not necessarily so, I imagine.
Yeah, vertical integration in theory could be really, really good for the end user.
If done in that kind of spirit, I guess. Yeah.
Amazon is vertical integration. Okay. Amazon is wild, unconstrained ambition, massive amount of reinvestment in a business over a very long period of time. It's incredibly vertically integrated. It's probably the best example of a vertically integrated platform. And does it work for everyone in that integration, in that stack? No. It works quite well for the end user sometimes. It doesn't work terribly well for some people that are supplying in there. It didn't work very well for bookshops, dare I say. There are winners and losers.
Yeah, of course.
Vertical integration in financial services should be great, because it should mean that everything is joined up, and what the end advisor is telling you, is for your strategy, your financial planning strategy is fully properly linked to your portfolio, and on and on and on, and it's all integrated properly. I think that coming back to synergies, I think that early consolidators saw it as that's a soft synergy. We can push the price up here. We do everything internally. We do 1%, and your clients be better off. You just need to go and tell them it's double the fee from where you were before, sort of thing, and try to not think about that too hard. And I think that, that was used a lot. And I think the regulators review that they did in 2018 was, they were looking at, I'll just say the word, they're looking at churning.
I was going to say, if you're churning something that's more expensive, that's not good outcomes.
And of course, everyone that's involved in this space then goes, oh, we don't do any churning. We wouldn't characterize it as that. Well,
but we are banking on this client bank and X% coming over here and all of that. Yeah.
Yeah. You've just got to look at the assumptions that they're making. What are they assuming comes across, and when and how? I think that it can be good. It can be bad. I think a lot of deals are not finished until 3-4 years later, when frankly the journalists, no offense to them, but they're not too interested in whether that person got a good deal or a bad deal because they sold 4 years ago, you know, and it's all over, and they just kind of, oh well, I got most of what I thought I was going to get, you know, and it's kind of long in the memory. I think for a client, I don't know. I think there's a lot of people that deal with SJP, Smith and Williamson, places like that think that they've got a great advisor, great service, great proposition, everything else. Our regulator is not a price regulator, and they're certainly not a value regulator. You know, so if the independent financial planning space wants to really continue, I think they've been on a really good positive march. If they want to continue that, they probably need their own consolidator. You know, because I don't think there's a consolidator for lifestyle financial planning businesses. And more financial education. I noticed Pete was on here earlier. I don't know if he's still on, but you know, an absolute trailblazer in that regard. More of that is needed so that people understand this is what I'm paying, and I'm actually getting what I think.
This is what to look for. This is is what you can maybe expect to pay for this type of work. All of that.
In all walks of life, increasing education increases efficiency in markets. You know.
Yeah, that makes sense.
But it needs ambition.
We're almost out of time. I'm going to sneak in one question because I said I would ask it. Pete says, I'm still here and thank you. So that's nice. Hanging on.
All the way from Penzance. They've got the best internet down there, you know, because of EU subsidies. Right? Yeah, they have got crack it. That's one I went to see Pete. And he's like, internet round here, it's amazing.
We're going to decamp to the best part of the UK.
Nice part of the world. Yeah, for sure.
Cool. So the one thing that I said I was going to ask kind of in the sort of teaser for this was around peak M&A. So do you think we've hit it? Do you think there's still more to go? Has the train run out of track? Any more kind of analogies that I can throw in here? But what do you think in terms of future crystal ball gazing type stuff?
I think there will be. I think there'll be a few more startups. Some of them are just, no offense to those people, but some of them are like, 10 million and a sort of hope and a dream sort of, type
startup
thing.
Consolidators, you mean?
There's been a few of them, and increasing access to capital has meant that you've had a few people that have just sort of borrowed a strip of debt from somewhere, and they're going to have a go, and that's fine. I think that consolidation as a whole has moved on, and I started life in MPI, which was a vertically integrated business back in the day, £5,000 a year and £20 a month lunch and vouchers, and I was in the door. The biggest employer in Tunbridge Wells at the time. Now, if you look at maybe Fairstone and Bell Penny, a few of these firms, they're the product providers of the future now, because they've acquired lots of businesses, they've integrated them, they've consolidated them, and ultimately they are big firms in their own right. So we're kind of going a little bit full circle here, I think, in that regard. There are one or two debt providers, I'm not going to mention them by name, there's one in particular. There are one or two debt providers that have supplied a lot of capital to the consolidation space. And I suspect that there may be some convertibility to some of their capital, so you can convert it to equity. And quite often, if there are constraints on capital in the future, then they can sort of drive some consolidation in that space. So I think there might be some consolidators that wind up getting consolidated. Mm-hmm. I think there almost undoubtedly will be a consolidator for lifestyle financial planning businesses, because we, like in this little space that we occupy, we know the value's there, so it's just someone else is going to see that at some point.
And those are normally, from the people that I speak to, they're the good, strong, robust businesses that have a plan and all of that, isn't it? So
quite often, yeah, there is definitely a correlation there. They're good, strong businesses, but the owners of those firms are often running out of track, and therefore they need their exit as well. And this generation gap often means, there's not the people in post to take over. So I think we do need that. I think that the capital is helping, in terms of allowing internal deals to work. I think some of the sort of financial planning firms that maybe had a couple of million 10 years ago of revenues, annual revenues, they're now like 4 or 5 million. They're much bigger firms. They're training their internal people, and so I think that there's some really positive development going on there. I don't see the private equity funded side of things running out of steam anytime soon. I don't think we're at peak M&A yet. I think if you think of baby boomers going into retirement, their advisors are a similar age. So that's the quantum.
That's the pool. Yeah.
That's the pool, and they're going to need to go into retirement. And as they go into retirement, they've got a few more options now than they had 5-6 years ago, which I'm delighted about. So I think there's the most important thing for people that are considering exiting is to everyone says it, but it's true, is to start planning early as you possibly can. Start investigating. Be careful about where you're learning from.
Okay.
And a lot of people think, oh, I need to know what my value is. I'll go and talk to a few consolidators. You'll get dragged into a deal. And I don't blame them for dragging you into a deal, right?
Yeah.
Their job is to buy firms. So, a lot of desktop research, a lot of finding out how things work, a lot of personal financial planning. What are you trying to achieve for your family? What's the time frame? And then try to get out with your dignity.
Yeah. Okay.
Yeah.
Right, well, loads to think about there. So thank you so much for that. I think we'll draw it to a close. Thank you to everyone who joined us today and for watching. Thank you, Rob, for your time.
Pleasure.
As always, pleasure to chat. And hopefully we'll see some of you again this time next week for our next instalment. So until then,
I might even watch next week.
Yeah, maybe tune in. Maybe we converted you, Rob.
I wish I had time for that. I'd love to. I'll catch up on one of the other platforms. Yeah.
On demand, that's it.
On demand. There you go. I'll catch up on demand. Yes,
Thank
indeed.
You. Cool. All right. Perfect. Lovely stuff. Cheers all. See you again soon. Bye.
Bye.